The collapse of the 16th largest bank in the U.S. on Friday has Canadian tech experts worried about the ripple effects in their sector. Members of Canada's technology sector say they're worried the collapse of Silicon Valley Bank will have a chilling effect on investments in their industry. The president of the Council of Canadian Innovators is worried that the chilly environment for venture funding will go from bad to worse because of SVB's closure. Benjamin Bergen says that the bank's collapse is likely to limit the pool of capital that companies can potentially access. Well, joining us now to give us his take on the collapse of SVB is Brendan Caldwell, director at Caldwell Securities Ltd. Brendan, welcome back to Forum Daily.
Nima, great to be here.
So can you walk us through the collapse of Silicon Valley Bank on Friday and whether this was connected to high interest rates at all?
Can I just answer yes and be done? So yes, it is connected to high interest rates, in as much as, like many banks, Silicon Valley Bank had a lot of very short-term deposits, demand deposits that people can access. And whereas they invested a lot of their money in much longer term investments that they had to mark to market, that is to say, price at what the market is actually willing to pay for those. Now, it's not a problem as long as you don't have to sell those investments. But what was happening, because the rumors started circulating publicly last week that Silicon Valley Bank might be in trouble, just like the scene in It's a Wonderful Life, where George Bailey tries to keep the savings and loan open with his own personal money. All the depositors for savings and loan came rushing to the bank, electronically rather than physically or literally, and demanding their money, which meant that the banks had to start selling a lot of those longer term investments, which were very much down in price, or underwater, as we say, very much underwater because interest rates had gone up. The longer term bonds that were issued at lower prices weren't worth as much now that interest rates are much higher. I hope that was sufficiently opaque.
And on that note, what do we know so far about SVB's clients? Did everyone who had money in SVB get their money back?
Yeah, and there's a lot of debate about that. So in the US, in the wake of the financial crisis of 2008, the lessons around which we seem to have learned little to nothing, in the wake of the financial crisis, they raised the guaranteed amount to $250,000 US dollars, obviously. And that means the federal government would guarantee up to $250,000 of depositors' money per account. But after the Treasury Secretary and the President said there will be no taxpayer bailout of Silicon Valley Bank, they've now guaranteed all the depositors all their money. And I'm even familiar with one company that's able to draw on its line of credit. So Silicon Valley Bank is even extending more credit to it. So it's, at the moment, there's money for everybody. Who ends up paying for that? Well, not the taxpayers, or maybe they will be.
And we're already starting to see the ripple effects of this closure. We saw Signature Bank in New York close on Sunday after customers started withdrawing cash. So can you tell us a little bit more about the broader impact of this on banks in the United States, both regional and national banks?
Certainly. So they've been messing about with the rules, and there's really two sets of rules for banks. Putting it in simple terms, you have more than $250 billion. Yes, $250 billion in assets, 250 billion. You're subject to one set of rules, and you're subject to a less stringent set of rules if you're under that threshold. Silicon Valley Bank, I think, had 219 million, so it was the less stringent threshold. And what had happened with a lot of these banks is they'd taken short-term demand money and invested it longer term. As interest rates had gone up, all these banks got hit, and then couple that hit in terms of the price of the assets that they owned. But then as the depositors started withdrawing their money, they started incurring realized losses on those assets. And that the thing just began spiraling out of control. What it may mean, as your prelude suggested, is that, yeah, it might be more difficult for venture capital companies to access capital. The shame of it is, the reason these banks are out of business has nothing to do really with lending to venture companies. It has to do with buying longer term bonds and mortgage-backed securities. So it has nothing to do with what their ostensive purpose was supposed to be. It's a frustrating situation.
Frustrating situation indeed, Brendan. We're going to have to keep our eyes on this developing situation, but we are out of time. Thank you again for your time today, Brendan.
Thank you, Nima.